we do have Shibani Sircar Kurian joining us on the show and Naresh joining us on the technicals. Naresh, let me begin by asking you a bit of a moderation from the highs of the day, but is 24,000 that floor that one needs to watch out for?
So I would expect 23,900 to 24,400 should be the new range for the index. The only concern is the bank Nifty has not made a similar recovery. And we continue to see the largest weight, HDFC Bank, not able to sustain that 1790, 1800 mark. So we remain in this consolidation, say a little bit of a bounce back coming in oversold sectors. Say yesterday it was auto, today it is FMCG. So that tells you we are still in a consolidation, but 23,900 now becomes a pivot point for the momentum.
Okay, that's the take coming in on FMCG. Let's welcome on board Shibani as well. Shibani, hi, afternoon, and firstly wish you New Year greetings from all of us.
Hi, and wish you all a very happy New Year as well.
Right. Shibani, tell me, is it going to be as happy for FMCG? You think staples will finally bottom out, or do you sense pressure will continue?
So it's been a mixed bag where the entire consumer and staples pack goes. What we have been noticing and what management commentary over the last few quarters has been that while the urban demand has been somewhat slowing down, there is an uptick that we are seeing on the rural side. So overall, it's still a fairly mixed bag in terms of growth. And even if you saw the last quarter numbers, the volume growth numbers were fairly muted. However, what we are seeing is that from a rural perspective, demand does seem to be improving. With inflation now seemingly coming under control, especially food inflation, real rural wages are finally, after a very, very long period of time, showing some signs of improvement. Data also seems to corroborate that there is some uptick where rural employment is concerned. And that, along with, of course, the good output in terms of the crop, both Kharif and expectation of a good Rabi, is supporting rural demand. So at this point in time, our view on the staples segment is still fairly mixed. We are looking at companies that derive more demand coming from the rural side, while urban demand has been slowing down. Valuations in pockets are still not very cheap. However, compared to their long-term history, valuations are close to their long-term averages. So therefore, we have been fairly stock specific where the entire consumer and the staples pack goes.
That's a take coming in on consumption. Yes, hopefully that the sowing season turns out to be better, and that really supports the sentiment as far as the farming community is concerned. But taking stock of ONGC and Oil India, a couple of news flow around it. Naresh, of course, there was that brokerage note with a 58% upside coming in from Jefferies this morning on ONGC. But the fact that the oil prices have finally managed to get out of that barrier of $75 and it's now at close to 2 months high, that's also supporting sentiment on Oil India. What do you like from the energy basket?
So the whole basket looks interesting because the extent of correction has been large. So if you look at ONGC, the stock corrected from 340, 45 levels all the way to 235 levels. So that's more than a 30% correction. And the bounce back even now, it's still down 25, 30%. So out here, slowly and steadily, there should be a rally. Any dips back to 250, ONGC still looks interesting. Same is the case with Oil India. The stock is back at the same place where it was almost 8 to 10 months back. The stock has corrected from 750 all the way down to 430 odd levels. After today's move, also any fade-off move in the next two sessions, say closer to 470 odd levels, would be a good buying opportunity for Oil India.
Right. Okay, that's the take coming in on some of those oil and gas names which are definitely on a tear. But Naresh, what's your observation within the auto pack? Because some of the auto majors which have not come out with such great numbers also for December sales, they too are flying up. Does it seem like auto is making a comeback and a meaningful one at that, or do you think it's too early to say that?
So if you look at auto, the reason for the bounce back in a lot of names is because these stocks corrected almost 30% from the top. So that is where we are seeing a bounce back. Even in the Tata Motors, which has corrected a lot, we are seeing bounce back in the last 2 days. But this is a bounce back trade, then we again go sideways. Say Maruti also, we go to say 12,400, 500, then again go sideways. But the leadership has clearly been changed. Eicher Motors, which we are looking at for quite some time, as the relative outperformer, has broken out into new all-time highs. So going forward, every day, Eicher Motor becomes a one on the two-wheeler side. Mahindra and Mahindra has consistently been an outperformer. So those two will remain outperformers and bounce back trades could continue. So at current levels, Bajaj Auto looks interesting for a bounce back trade.
Shivani, today, of course, Avenue Supermarts is gaining while Zomato is down 3.5%. Do you think the street is making too much of that Q3 update that's coming in from Avenue Supermarts? I mean, do you think that 10% move on Avenue is warranted and 3% cut on Zomato is warranted? Shibani, the question is for you.
That's for me. Unfortunately, we will not be able to comment specifically on stocks. Yeah, it will be very difficult for me to comment on a particular name given our compliance requirements.
But help me understand, do you think people are making too much of this quick commerce disruption or we are making too little of it?
So if you look at quick commerce as a basket, I think there is a significant growth opportunity that is clearly present. One, the kind of expansion that you have seen so far is only addressing a very small segment of the total addressable market. And as you know, that many of the companies which are in the quick commerce space today have adequate cash on their balance sheets, and therefore there is room for them to expand into markets and geographies today which are completely untapped. So if you look at the presence of dark stores today, they are concentrated in the top 4-5 cities at this point in time. And therefore, from an expansion perspective, there is considerable headroom for growth. Having said that, is it likely that the entire grocery and the way food shopping takes place moves to the quick commerce platform? The answer is possibly no. And there will be some amount of segment which is catered to by companies which offer value, and therefore that particular segment of the population will continue to go to those kind of segments and stores which typically will cater to that kind of a population. However, in terms of growth opportunity where the entire quick commerce segment is concerned, we believe that there is significant room and headroom for growth. And as I mentioned today, most of the large players in the quick commerce space have adequate cash on their balance sheet, which means that expansion of stores, especially dark stores across geographies, is likely to remain fairly strong. And therefore, the growth numbers that will possibly come through will also remain strong, at least in the near term.
Okay, point taken. But since we're talking about quick commerce, hear out what Karan Turani had to say on the same.
So I think as of now, I think Blinkit will maintain its edge. That is what our assessment is broadly for now, given the market leadership, given the kind of numbers they are posting. We don't see them gaining market share. We don't even see them losing market share significantly because they have got their moat. Whether you call it the location advantage, whether you call it the SKU variety, and everything put together, the higher AOV, higher take rate, everything. So I think they will maintain their moat. They will stand to be better and ahead of competition. As far as Instamart is concerned, I think definitely things are right now changing. If you look at Instamart's growth, I think you will see some kind of changes here post the listing. They will potentially look to gain market share as well over the near term. And at the other end, you've got Zepto as well, who's also executing reasonably well. And then you've got a large variety of e-commerce players who are wanting to get into quick commerce. So definitely the market is going to be fierce in terms of competition. The fragmentation is going to be fierce over the next 2 to 3 years. But I think Blinkit will maintain its moat. And there is a high likelihood that Swiggy Instamart will also make some market share gains over the near term.
Last year, we did see quite a bit of outperformance from the likes of BSE, CDSL, CAMS, the other stock market ancillaries, but the latest reports are suggesting that the F&O volume has declined by 20 to 30%, and we are back at the volumes that we saw in 2022, 2023, and that's after the latest regulations have come in. In fact, Mr. Nikhil Kamath of Zerodha is saying that all the implications of the new regulations haven't been even come into effect as of now, and it's going to decline further from here on. Shivani, just wanted to get a better sense from you. What does it mean for all the stock market ancillaries, the likes of 361 or Angel One or other brokerage and trading platforms, even BSE for that matter, if the volumes do drop the way they have been over the last couple of months?
Yeah, so this is something that we will have to wait and see as to how the volume trajectory pans out. Clearly, at this point in time, there has been an impact in terms of volumes because of the regulatory changes that have taken place. And that is something that is likely to show through in terms of some of the numbers on the brokerage side. Now, in the entire capital markets segment, the way we have been looking at stocks and sectors within that space is that, if you look at companies which are in the asset management space or in the wealth management space, these are better placed at this point in time as compared to companies which are direct brokerage plays. And therefore, we believe that while near term, of course, in the last quarter or so, markets have seen volatility, and that will result in some mark-to-market impact where AUM is concerned. But structurally, asset managers as well as wealth managers are better placed in the construct of the entire capital markets basket. In pockets, of course, we have to be mindful of valuations because in some pockets, valuations have moved up considerably. However, having said that, the way we are approaching the entire capital market basket is to look at companies which within the asset management as well as wealth management space, which offers a more structural runway and opportunity for growth.
Okay, that's that. Naresh, wanted to get you in on some of these capital market plays, and I recall discussing this with you earlier as well on where you see the likes of CDSL and Angel One, 361, or for that matter, even a BSE headed next because they've had a fabulous 2024.
So time for them to take a pause or maybe even a correction, given that we are seeing a top in terms of participation and it could remain at such levels or get lower. Even the cash market participation has reduced. And going into Jan, we see a change in lot sizes, etc. And many of these stocks have done really well. So if you look at the CDSL, it has been a one-way move all through the last one, say from 2023 or in 2023, the stock was 600, today it is 1800. So most of these names have done multi-X moves and now time for a pause. And you started seeing this, say, first dip happen in the Angel One, which has the most direct correlation with F&O volume. So that has started cracking. So that could again go back to 2500 levels. So for now, one is better off avoiding these names, waiting for a correction, even if one has a longer term view.
Okay, so that's on the stocks of some of these, market-related ancillaries. The market has moved into the red a bit, so 140 points lower, just around the 24,000 mark. But in terms of the stock-specific action, take a look at PTC Industries. That's flying away in the trading session. Lloyds Metals, if I remember it right, that was the stock that the Chief Minister was talking about. Mr. Fadnavis talking about how that stock is likely to do very well given the kind of employee support it's getting in terms of the workmanship. Just Dial, ONGC, Bank of Maharashtra, these are some of the other names that we are watching out for. And of course, IGL and UPL. Shivani, chemicals was a theme that pretty much did nothing over the last couple of years. We have been talking about the light at the end of the tunnel, but now chemical experts are telling us that 2025 perhaps can be the year of reversal. And these are the businesses that have great operating leverage. If the cycle turns, the profitability will skyrocket.
Yeah, so I would still approach the sector with some degree of caution. It is possibly likely that most of the bad news is behind us, but improvement both in terms of demand as well as pricing is something that is likely to take some time. So if you look at what has actually happened in the chemical space, there have been two key factors that have impacted the sector. One, there has been significant dumping as far as Chinese competitors go, and that has resulted in a decline where pricing is concerned. And there has also been a demand slowdown resulting in inventory destocking, especially in the case of global companies. Now, where global demand is concerned, we are possibly coming to close to an end in terms of the inventory destocking cycle. And therefore, from that perspective, it is possible that we will possibly be coming close to an end over there. Where pricing is concerned and as far as Chinese competition goes, the competition continues to remain fairly strong and therefore pricing action still remains fairly weak. We have not seen any signs of improvement where pricing is concerned. However, one thing is certain and clear that some companies which have invested in terms of building capacities, as and when the global demand scenario as well as the dumping from China starts to abate, these are companies that will be well placed, especially where specialty chemicals go in terms of getting back on track in terms of growth. However, we still see that a few quarters away. Valuations clearly have corrected considerably, and therefore, from that perspective, downside appears to be limited, but the upside will possibly still take some time to come through.
Okay, that's that on some of the chemical as well as fertilizer plays. Just looking at what IT is up to, and once again, you're seeing a slump there. Wipro, Techem, these are all stocks which are under pressure. Want to bring up the likes of Infosys as well, which is also down by about 1.25%. There's TCS2, which is down over 1% as we speak right now. Shibani, what's the sense that you're getting about how IT earnings are going to pan out this time?
Yeah, so typically, if you look at the quarter three is usually a muted quarter. Primarily, this is a quarter where you see a significant number of furloughs as well as holidays, which impact overall growth. And that's something that we have to keep in mind when we look at the quarter. I think what will be important will be one commentary in terms of demand, especially in large verticals such as BFSI, high tech, and the like. What we've also seen in terms of data points, banking as a segment, especially where North America banks are concerned, is starting to see some improvement as far as discretionary demand is concerned. However, this is still fairly early days. However, Europe continues to struggle, and Europe still forms fairly large part of the revenue pool, and therefore that is something that we'll have to wait and watch for. Where IT is concerned, we do believe that incrementally growth should start to recover, especially given that macro data in the US seems to suggest that growth is holding on. And we have now started seeing the rate cut cycle as well start. However, as I said, the key also will be to see how the rest of the world and North America pans out in terms of demand. Overall, if you look at the sector structurally, with the adoption of Gen AI, there is a huge opportunity for growth that should play through over the next couple of years. However, one must also remember that if you look at long term growth rates where IT is concerned, high single digit growth in terms of revenue is something that one should possibly look at rather than extrapolating the kind of mid teens growth that you saw post COVID, where there was significant uptick as far as discretionary demand is concerned. Now, if you look at the sector in pockets, valuations, especially where some of the larger IT names are concerned, are fairly in line with where market valuations are. And therefore, we continue to be positive on the sector as a whole. However, as I said, this quarter, one should watch out for commentary in terms of deal flow as well as expectations going forward. The rupee depreciation will help in terms of margins, and therefore margins should remain largely stable. That is what one would possibly look for in this particular quarter for IT.